So most investors think this way. If the P ratio is low, it must be cheap. If the P ratio is high, it must be expensive. It sounds logical. Let's say you're buying a clothing business that makes $1 every year in profit, and you are paying $10 to take over the entire business. Meaning it takes 10 years to break even, assuming the earnings stays the same every year. That's a P ratio of 10. You hear things like, oh, this stock is trading below P15, so it must be undervalued. But here's the problem. Take SIA Airline for example. Right now, the P ratio is trading about 8.2 times, and the share price is currently trading about $7.60. It may sound like a bargain, but if you bought and held the stocks from 2007 to now, that's almost a 15 years period, you will still be down 44%. So doesn't that make you wonder, if investing is just about buying cheap and selling higher, why didn't that work for SIA? Because the P ratio doesn't tell you the full story. Here's the good news. You don't have to check everything. Just focus on 2 key factors. You can eliminate 95% of the bad ones. It will save you hours in research and boost your success a lot higher. First, PE doesn't tell you if the company can make money consistently. Earnings itself can be all over the place. They go up in good times and they crash during downturns. For Singapore Airlines, if you look closely at their earnings, some years they make a profit, some years they don't. If earnings are unstable, PE ratio itself becomes meaningless because it's constantly jumping around. And that's the first thing you got to question. Second, PE doesn't tell you the quality of the business. Imagine you see a luxury car sold 20% below market price. Would you immediately assume that this is a bargain? Or would you pause and think, wait, what is wrong with this? Same with stocks. A low PE might mean that something is broken in the business. For Singapore Airlines during the pandemic, they were hit hard. Businesses were slowing down a lot. And guess what? Just to survive, they have to borrow huge amount of money. If you check the numbers closely, from 2016 to 2022, their cash level didn't really grow. So when the crisis hit, they have no buffer. At the same time, the debt level has been rising. Only recently, when the flights resumed, then they were able to pay back their debts. So again, a P ratio doesn't tell you any of this. It may look cheap on paper, but behind the scene, there's a lot of pressure. So how do you apply this? As a rule of the thumb, I have this table to help me. If the P ratio is less than 10, it could mean that it's undervalued or there is some hidden problems. For P10 to 15, it might be a mature company. For P15 to 25, it's a normal range for healthily growing business. For P25 to 40, high growth is expected and priced in for future growth. If the P is above 40, it's either a very high growth company or the earnings are high. Be cautious. Want to know where to get earnings, cash and debt level in under 1 minute? Go to physical.ai and key in the company name or the ticker symbol. Go to the income statement and check out the net income. There, you will get the earnings. Next, go to the balance sheet, check out the current assets. Here, you will get the cash levels that the company owns. Next, go to liabilities and check out the long-term debt level. I hope this video helped you. Think deep, invest smart. Next video will introduce a different valuation that is much better than PE ratio.